May 24th, 2025, and welcome for a new edition of the Quantaraxia market dashboard for this week. A week that has been a little bit more eventful than the week before, that were only propelled by a sentiment of relief, no actual news. This week we had actual information, such as interest rates spiking in Japan and spilling over the US. After that, the downgrade of the US debt credit rating by Moody's. I believe it's the first time since 1917, as I've read. And then by the end of the week, another episode on the tariffs. So we'll try to unpack this and a little bit more and analyze what the situation is at this time. So we'll start first with the general dashboard, which shows us that we are back in a situation that where we were at the beginning of the tariffs. We have all the S&P, so US equities, US bonds, and US dollar going down, and this will be confirmed with the relative performance chart versus other markets when we look at either the S&P or the US dollar. And in the same way, we have the, let's say, the safer, harder assets in terms of, let's say, inflation, which is gold and Bitcoin, that have been doing much better over the last week. So just a little note on oil. The only thing that saved oil from a bigger down move this week was the announcement that Israel was intending to hit Iran's nuclear program in a context where the US is negotiating currently with the Iranian government to find a solution for their nuclear program. So this is where we are now. We don't see any much change on the activity ratio, whether it's volatility or volume. So it doesn't peak yet, but we've seen some down moves on this week on the major asset classes, specifically US. If we look at what happened since the beginning of the year, so large swings, but it takes the S&P about flat, the Nasdaq about flat as well, the Dow Jones slightly negative, and the small caps have been hit the most. Well, they are the more likely to be impacted and the more at risk to see some bankruptcies from the disruption of the supply chain with China and the trade war that can happen. So it's not a surprise that they are the most hit financially on the markets at this time. On the bond side, we see that TLT bonds doesn't play its role of safe asset anymore. So the long-term, let's say, expectations for the US debt is negative, which goes with the downgrade of the US debt by Moody. On a much more medium term, the situation is not as bad, as we can see with the IEF ETF midterms US treasuries. And the last thing that we can note, obviously, is again gold is the big winner for this year. The last probably remaining safe asset at this point, and Bitcoin with the IBIT ETF, which is plays both role. Actually, it's a harder asset than any fiat currency because of the limitation at 21 million. At the same time, it's still not established as a major safe asset at this time. But so again, it's more harder. So we have both situation on Bitcoin, which is a risk off asset at this time, as well as something that is harder than other assets. So if we look at the charts right now, so here this is the S&P 500. So we see that on the day where Japan started seeing its interest rates, its yields spiking. So the market, the US market, opened down, recovered by the end of the day, and then over the following days, it was going down with the US rates going up. So the US equity market is starting to notice what's happening on the bond market. I always say that there are two kinds of market. There are the dumb markets and the smart markets, and obviously the bond market is the smart one. Why? Simply because this is the 10-year yield here. When the government panicked on what was it, April 9th, I believe, and started announcing some potential trade deals, then the market recovered. Let's say the yield started going down. When it was announced that the trade war was going, really intense, was intensifying significantly. Interest rates in the US were spiking, so the announcement of trade deals gave some relief. Unfortunately, the new trade deals have no impact on the bonds market or the yields at this time. So, and when the US stocks market was still rising on the sentiment and again on no news, the bond markets was telling a different story, and yields were continuing to rise and bond going down. So again, this is why you have the markets that you have to look first and then infer some conclusions on the other markets next. So the key will be to monitor what's happening on the bond market. What happens on the bond market is that the government desperately needs some lower interest rate because it has 9 trillion to roll of debt over 2025, and the US cannot really afford, specifically from the long term, to roll that debt at nearly 5% interest rates currently. The burden of the debt will basically prevent any government to do anything in the future. So it's not impossible. So that's probably why Trump, seeing that the trade deals had no positive impact on the yield, started going back to the trade war again, with the idea potentially of triggering a recession that would give some room to reduce the yields on the treasury notes and on the treasuries. Unfortunately, Scott Bessent spoiled the party on Friday, yesterday, when Trump announced, potentially 25% tariffs on Apple and 50% on the EU. Scott Bessent, spoiled the party because when the rates were starting going down, when Bessent announced that new deals were coming in, the rates started going up again. But anyway, there's probably a lack of coordination at this time. We'll see what happens. Next, we have gold. Unsurprisingly, in a context where uncertainty is rising in the market, gold is rising with uncertainty, so that's not a big surprise. We are going back to the highest high. Same thing for Bitcoin here. Where Bitcoin has hit new highs. It corrected slightly yesterday, but for instance, the short-term uptrend is still there. Again, in the context that we are at this time, it's not a big surprise. I wanted to go back to the US dollar that is being sold. We had again the similar stuff. Similar situation when Trump started talking about the potential trade deal. We had a relief in the US dollar going down, but the downtrend in the US dollar has resumed. So not really good. Again, US stocks, US bond, and US dollar going down is not a positive, obviously, for the US. This means that money is going somewhere else. So if you look at the activity on the market, our activity indicator is showing that the activity is going down. So the market this week was going down, but it was not a sell-off. It was it went down in a, let's say, in an orderly manner. So it's not surprising to see the activity going down on each asset category. And obviously overall as well. So no surprise here. What is a little bit more interesting is that when we had seen from the beginning of the year that money was moving out of the US again, or overperformance of European equities over US equities, US bonds not doing so well, the US dollar not doing so well, it's not surprising that when the market recovered, we had kind of a pause, but this week, when the US market going down, and again, I could recap the same thing again, we see the opposite trend resuming, where foreign markets are overperforming the US equity market at this point, meaning again that money is leaving the country at this time. If we look at the major asset classes against gold, this is the same story. This is, we had a pause with the same narrative about the tariffs, the sentiment of the past week. It seems, at least this week, to be resuming on the downside, with most asset classes underperforming gold. And then again, it's always the same thing. What we've seen over the past months, and that stopped on the narrative of trade deals coming, which stopped the bleeding, resumed again this week. Again, all these charts are basically showing the same thing at this time. And yes, that might be the last slide, just to show you where we are in terms of long-term bonds in the US. This is the TLT ETF. We are at max drawdown, around the max drawdown, and we are back at the level of interest rates where the government kind of panicked again on April 9th and started announcing trade deals that were non-existent, to be honest. So the risk now is these bonds going lower and interest rates going higher. So now you understand the context where Moody's is downgrading the US debt, and this is actually a risky situation at this time for the US market, because the credit market is the basis for everything, for itself obviously, but for stocks, for all the economy. So this is definitely the market to monitor. Look at bonds, what bonds are doing, look at what gold is doing, and you will see if the situation is deteriorating or improving. So this is where we are now. This was quite an eventful week. I believe it sets the picture for the coming weeks. We have earnings, I believe, next week, with Nvidia announcing its results. You may have seen on the equity volatility term structure, that there is a spike over next week around the Nvidia earnings. But more globally, the next weeks will define what will happen next on the bond markets. The equity markets is kind of just a consequence at this point, and the gold market as well, if it's going higher, because this is the only safe asset at this point. So if the situation will deteriorate even more from where we are now, we need to monitor gold, maybe potentially Bitcoin, and we definitely need to monitor the bond market. This is where the information is at this point. So stay tuned. Until next week, thank you. Enjoy your weekend. Bye-bye.